Legion, welcome to Thursday Daily Pay, where every swing can bring a little extra cash flow your way. Today we're diving deep into one of Kurv's newest heavy hitters, KYLD, and I'm going to call it KYLD, because they are killing it already. KYLD, their high-income ETF that just stepped to the plate with its first payout of 16 cents. And this is a weekly payer from Kurv. 16 cents weekly. I trust Kurv so much, and I don't get paid a dime from them, but we're going to take a big deep dive here.
In the heat of battle, I say naughty things. You have been warned. Are you not entertained?
KYLD is Kurv's answer to high growth crowd who still want consistent income. It's actively managed, not an index follower, and it's designed to generate weekly distributions using a basket of high growth equities combined with option overlays to crank out yield. It trades on the CBOE BZX exchange, carries a 1.16% gross expense ratio, and nets around 1% after fee waivers. That's pretty typical for an actively managed income ETF, especially one running option strategies like this. There are three major engines behind KYLD's income machine. Synthetic long exposure. Instead of just buying shares, KYLD can synthetically create exposure using long calls and short puts, a strategy that mimics owning the stock but frees up capital for other trades. This gives them flexibility and leverage, up to 200% of net assets. They also write options for income. This is the moneymaker. KYLD writes covered calls, and sometimes even short calls or puts to collect option premiums. That premium is the lifeblood of your weekly payout. It's not guaranteed, but when volatility spikes, so does the income. Another way is collateral yield. While waiting for those trades to settle, the fund holds short-term treasuries or fixed income instruments as collateral, earning a little interest on the side. Every drip adds up to that Thursday daily pay. So what's the catch? Well, every income strategy has a trade-off.
Rates. Yes, if you don't recover from the dividend, you don't get a dividend. If you have a $1,000 dividend, they pay it to you from the NAV. The fund goes down by $1,000. Now, they're supposed to be busy little beavers trading and winning their covered call trades so that they can recoup and build that money back in the NAV, called recovering, and then pay you anyway. But here's the thing. A lot of them are really dirty dogs.
In this case, writing calls caps your upside. Let me say that again. Writing calls caps your upside. If you listen to the Oracle, he's been going on about covered calls, so this is your money. You do what you want with it. I trust Howard Chan, and you're going to see later why I do. If those high growth stocks surge, KYLD's profits can't fully keep up because it's sold the right to that upside. Remember, that 16-cent payout isn't locked in. It can vary week to week depending on how much premium the fund captures. Some weeks may be smaller, some larger. Distributions can even include return of capital. This helps you on your taxes, but some people are shy from it. This does help too to smooth payments, but reduces NAV over time. Take it or leave it. Kurv's managers focus on implied volatility. The higher the IV, the juicier the premiums. So, KYLD's holdings shift toward names or ETFs with rich volatility environments. Think growth and tech names that swing. It's also a non-diversified fund, meaning it can concentrate more heavily in fewer positions if that's where the opportunity lies. That concentration is part of what gives KYLD its punch, but also its risk. Kurv's single name ETFs, like this week that we're getting the first payout on, were MSFY, Microsoft, and AMZP for Amazon. Those hit harder per share. One, they're monthly, not weekly. And two, they rely only on one stock. You take some of the upside and all of the downside. Remember that. KYLD spreads its swing across multiple growth names, so it may deliver more consistent volatility harvesting across markets, not just one ticker's mood. This is why you have to pay a higher price for it. So, in other words, MSFY and AMZP are home run hitters, but KYLD is your steady lineup player, built for weekly consistency. Let's keep it honest, Legion. KYLD isn't a magic money printer. Risks to remember. Income may include return of capital, which reduces the NAV. Option trades can backfire in sudden moves. Think anytime Trump tweets out some crazy tariff or new idea or whatever's going on with Trump. Synthetic exposure increases complexity. Distributions are variable, not guaranteed. If you follow these weekly pays, they go up and down. You already know about this. And taxes, well, I ain't no accountant or tax professional, so seek those people if you need them. But option premiums and return of capital are treated differently than qualified dividends. Kurv even highlights potential tax timing advantages, but always talk to your advisor, like I just said, before you let the IRS bench you. Legion, before we close, let's talk about the man and the team running the engine behind KYLD. Because when you're counting on weekly pay, you want more than just a catchy ticker. You want a credible pilot at the controls. Who's Howard Chan?
ETFs that we have now is that we do try to balance income with price appreciation. So one of the things that is really important to us, and we get feedback from investors, is the reason why many investors have exposures in technology is that there is growth and there is price appreciation in the stock, right? So how do you balance getting some price appreciation and then getting dividend distribution from a stock that doesn't distribute dividends?
For one, he's definitely not this guy.
But why did they get so much less dividends? In other words, if these people think simple, they think, hey, I lost half my shares, but I'll get double the dividends to make up for the shares, and they don't. Why does that happen?
Okay. You're not going to love my answer, but it's because when you get if you had reinvested the shares, your dividend would be the same. Not the per share, but the amount you get paid. So when you divest to cash, when you take the dividends, you're deliberately reducing your exposure to the fund. You're saying, okay, great, thanks for that nice dividend, Jay, 5% this month. I'm going to put it over here. You're letting the fund position decline. We're paying out at the same rates. Yes, I know it varies, right? Tesla varies between 50 and every once in a while there's 100 in there, but generally it's 50, 60%. It's paying at the same rate, but your position is smaller because you've divested to cash. You're not putting it back in, and look, you could choose how much you want to put back in, but you're letting it's almost like you said before, if I could hold stock and just take some and sell some every week, you're reducing your exposure by not going back in. But that's your choice of what to do with the dividends, right? So the rate has not changed, right? We pay a very similar rate. If you look back at all the Tesla distributions, they generally stay in the same range. One of the more consistent ranges of rates. But your position is small.
So how do we explain this guy? Can you see my screen?
Well, that might have been, look, I'll look at that.
Howard Chan is the founder and CEO of Kurv Investment Management and brings 20 plus years of investment management experience, having previously worked at firms like PIMCO, which is European ETFs, and Goldman Sachs Asset Management. Yeah, that's right, boys. Those ones. He appears regularly in industry interviews explaining how Kurv uses option premium strategies and volatility harvesting to drive income. He and Kurv position themselves as bringing institutional tools to everyday investors. Why this matters for KYLD and you. Since KYLD's strategy is option heavy, you want a team that understands derivatives, implied volatility, and risk management. Oh my God, just think if you were doing that on your own. If you can, more power to you, go sell courses. Me, I like paying people like Howard. Chan's commentary supports that he and the firm are working consciously in that space, which they're here to make you money. That seems to be their goal. Nobody can promise anything in the market because nobody knows which way it's going. When Howard goes on these YouTubes, which he regularly goes on, I've watched him on, I'm showing a clip from the Oracle's public discussion. He's been on numerous other guys that I watch their channels as well. And he shows his transparency. He also has a Kurv's podcast. They have a Kurv Your Enthusiasm, which features Howard discussing volatility strategy and how Kurv extracts its premiums. You can find out they're not hiding from you. Some people don't want to talk about what's going on with their funds, why they went from $6 to $4.50 in less than 3 months. But anyway, back to Howard here. The firm's About page emphasizes experienced leadership, including Chan and other seasoned pros. It gives you some comfort that this isn't a startup shell. They might not be the biggest players out there, because I don't get it. Like, Kurv seems to have the right goal. They want to be engaged with the community. They aren't trying to screw you out of your money like cough cough yield is. But I digress. Hey, I do got to give you some words of caution, just for some balance here. Trusted a leader doesn't equal risk-free. As much as I like Howard, it's still a covered call fund. You get all the downside and a little bit of the upside. Even the best teams can still lose the money if the market misprices volatility or underwater movements hit. Always align the strategy risks with your personal goals. Is this what you want? I want extra sources of income coming in all the time. That's my personal goal. Build these up to buy better shares of things. I don't need thousands and thousands of these shares. I just need them to start buying me a share of VT or a share of QQQI or something. Well, not really QQQI, but like, you know what I mean? Like QQQ or SPY, VOO. Pick your flavor of the better stocks in the market, So, if you're leaning into a strategy like KYLD, weekly pay, options, overlays, synthetics, you're trusting more than just the ticker. You're trusting the crew at the helm. That's why I like Howard Chan and the Kurv team. They have a track record, very active in the community, and a clear strategy. But remember, even trusted pilots fly through turbulence. Hold on tight and fly consciously. And that, Legion, wraps up today's Thursday Daily Pay deep dive on KYLD. Kurv's high-income powerhouse swinging for weekly consistency under the leadership of Howard Chan and his crew. The strategy's bold, the team's legit, and the payouts are rolling, just like how we like it. But before you head out, we're doing something big. When the Centurion Investing YouTube channel hits 1,000 subscribers, one of you from the Legion is walking away with a $100 Amazon gift card. We already gave $10 away in our 100 subscriber challenge, so you know it's legit. It's just my way of saying thank you for being part of this incredible journey. Every like, every comment, every share helps us grow this community of financially fearless investors. So hit that subscribe button, ring the notification bell, and drop a comment below. Would you rather ride with KYLD for that diversified income, or swing for the fences with something like AMZP or MSFY? Great income on Thursdays. Hey, remember, stay strong, stay disciplined, and remember, I own all these ETFs myself. It's not financial advice, just my daily pay wave. So see you next Thursday, Legion, and maybe one lucky soldier will snag that Amazon gift card.